All right, welcome everybody. We'll start here in just about 30 seconds. I just want to see if anybody else pops in. All the information is kind of going to build on itself today, so I don't want to leave too many people behind. Happy New Year, if I haven't said that before. Can everybody hear me? Once again, ask questions as we go. It helps me to hear from you and let me know that you're actually out there in the wilderness. And I hope that you enjoyed today's webinar. I noticed my little profile picture is about 12 or 13 years old, so we need to update that. I'm much uglier and much more cynical now. But welcome everybody. So we're going to talk about trade planning today. I figured it's a new year. It's our first webinar of the year. We might as well jump into it. I do have the coronavirus, so if I am a little squeaky, a little pneumonia-y, you know why. So there's that going on, but we turn in the corner, so all is well. All right. Can you guys hear me? Everybody's got me loud and clear? Okay, very good. Thank you. All right, cool. Thanks. All right, guys, well, welcome. So let's talk about trade planning. And like I said, please fire away with questions if you have them. It really does help me sort of steer things in the right direction, or a direction, I should say. So as you think of some stuff, let's throw it that way, okay? So the media is hard for us to ignore just because it's in our ear all the time. But I think that it's important to have a process in your trading that is absent and narrative. All right. And it's very easy to fall into that, particularly with the crypto stuff going on. You know, the narrative is sort of self-supporting of this move. The dollar narrative is easily supportive, but I think that there's more to that, and I want to cut into that a little bit more as to how we can develop a process that is absent a narrative. Okay, now I want to also sort of mention, I'm sure a lot of you do other things, not just currencies, and I realize this is FX Street, so we need to talk about currencies, but I want to just talk about trade planning in general, because there's more to everything going on a structural basis, all right? And one of those is this. Now I like to develop my trade plans on a fractal basis, okay? So first of all, I like to have a macro structure to things, okay? And that means, and this is the very important thing, okay, is that I like to measure macro on a rate of change basis. Okay, that's critically important. Now, whether we think, you know, the only economy that's actually going to measure growth in the world this year is China. Do we think that the Chinese numbers are accurate? No, they're not. But does it matter? Not really, because we're measuring them on a rate of change basis. Okay, in other words, have we seen improvement relative to what we were? Have we seen an improvement at what speed relative to what we were? Okay, and then it's a matter of seeing, and I'm going to let you do this analysis. There's tons of resources out there. But as far as what countries are in what phase of their economy. So for me, I like to put things in sort of 4 quadrants, all right? One of them is that Goldilocks phase where you have diminishing inflation but higher growth, all right? And in that environment, things like tech and consumer discretionaries and industrials do amazingly, where utilities and consumer staples don't. And probably more importantly, the dollar does poorly. And you're going to see a theme kind of cropping up here. All right. And then you're in the phase that I think we're in now. I mean, last night we hit cycle highs on copper, cycle highs on wheat, cycle highs on corn. Gold doesn't count because real rates are rising. Gold doesn't perform in that environment. All right. But We see the cycle highs in coffee. And while the Fed is telling you that we don't have inflation, by definition, guys, this is inflation. Let me pull it up for you. This is the CRB index. Look at it. This is since May. This is the price of stuff. Okay, this is inflation. Now you've got to remember the way that the federal government tells you or records inflation changes, and they do it in the very fine print, which is interesting, but you and I don't care about that narrative is the point to this. All right. So for example, let's say that, they used to have a basket of 16 products, basically, and of consumer staples and consumables, etc. And they used to say the price of these 16 products is the consumer price index. All right. Well, now what they've done is very silently under the radar, they've said, well, if there is a substitute product, then we're going to gauge inflation on that substitute product. So in other words, if your Colgate toothpaste used to cost $5 and now costs $7, but there's a Walmart brand substitute product for $3 or for $4, well then the price of that product is now deflated 20%. Meantime, realistically, it's actually inflated 20%. All right. So when you're judging your inflation, it's important to do it by looking at the underlying commodities of things. Don't go off just the CPI. Don't go off these other things that are fed down here. Look deeper in it. Okay. The Baltic Dry Index. Look at what's actually moving around in the world on a rate of change basis. And at the moment, we're seeing, while we're coming out of, we've got this K-shaped recovery, et cetera, on a rate of change basis, we're looking at fierce growth in the world and fierce inflation. Well, in that environment, the dollar does terribly. Okay. And then we've just come out of sort of a decreasing growth stagflationary period where we have, profits dropping off dramatically, but inflation rising. Well, the dollar does badly in that environment. The only time the dollar does well is when you have a deflationary cycle. Okay, you have growth dropping off dramatically and inflation dropping off dramatically. That is a period in which the dollar does extremely well. And well, after this sort of what I call quad 2, where we have this rising growth, rising inflation, we're likely to fall back into this deflationary period. All right. And in that zone, we're likely to see huge dollar strength to surprise everybody. And those folks that have made a ton of money in Bitcoin and are getting greedy with it might be surprised as to what that correlation is, because the correlation is very strong with the dollar. And this is an interesting quote-unquote narrative with the crypto stuff, is that the dollar correlation is still strong and in dollars, which means that it's kind of a commodity still, isn't it? I realize that the DeFi movement is flying, but everything's still priced in dollars. People are now starting to buy Polkadot, and for us US, we can't even buy it. And that's a true crypto asset that is actually priced in other crypto things. And I think that's the way the world's going. But for now, we still priced in this dollar movement. All right. So I'm not going to get into the underlying economics. We can do that next time. But for now, we're in this phase of rapid accelerating economy, rapid accelerating inflation. Dollar does poorly. So our underlying economic bias for the dollar is dollar garbage. All right. So now, and then obviously on the stocks front, we're looking at things in this cycle that do well: tech predominantly, consumer discretionaries, industrials, things that do poorly, utilities, REITs particularly. All right, real rates rising means that gold does poorly. You want to dump all your fixed income. Okay, all of those things are going to switch when we go back to that deflationary cycle. Okay, but this is, now if you're stock trading, you can look for things in the context of that framework where you can say, what are my favorite tech stocks? What are my favorite industrials, particularly energy? What is my favorite energy stocks that have, on sell-off days have diminishing volume? All right. They have rising volatility, yes, but disproportionately low realized volatility. So you have this lower volume on sell-off days in the broader market, okay, lower volume relative to the market, and also big implied volatility discounts. And those are the stocks you want to focus on within the context of that trend. And then to offset the other side of your book on things like REITs and utilities, there on sell-off days, you want to see much higher volatility, much higher volume. All right. So now you have a platform where you can short stocks that have the bearish aspects of the context of the economic cycle you're in. Does that make sense? So in other words, on the bullish side, let me get a new piece of paper and I want to write it out because it'll make a little more sense. You know, what does well in a inflationary growth period, right? Tech. So we'll just, you know, tech, industrials, energy particularly, right? And lately we've been seeing a lot of developing markets doing well. South Korea has just been off the hook. Russia been off the hook. All right. And what do we notice on up days here? All right. Volume, tremendous, huge volume days. Volatility, the vol of vol, dropping. Okay. And on sell-off days, you're going to see light volume, okay, and pretty light volatility. These are bullish markers in the context of this. So you can see we have an economic underlying framework, and now we have a price, volume, volatility metric for what we want to trade in the context of that. It's a process, okay? And then on sell-off days, you know, things like REITs. What's our favorite real estate stock to short? What's the worst looking company? You know, Netflix has been a wonderful short. Why? Well, people are starting to go back to work, etc. But Netflix, you're seeing on sell-off days, you're seeing huge volatility. Okay, volume days, and huge vol spikes. So you have something that is a consumer discretionary within the context of the market on massive volume sell-off days. So this is what you want to short on your book. Okay, then you can go to things like the VIX and you can say, right, what is our trending range? The top of it, 27 at the moment, the bottom of it, 20. So if you start to get to the top of the VIX at 27, okay, if you get to the top of the VIX at 27 and you get to, and you know, here, what are your shorts? Your shorts are the things that do not perform well. So you're going to want to short things like telecom, utilities, consumer staples, REITs. Okay, and here, and then you go and look at those stocks that are showing high volume, high volatility on sell-off days, and those become your shorts. And when you're at the bottom of the range, what are your longs? Your favorite tech stocks that have low volume on sell-off days, low volatility relative to the broader market on sell-off days. So now you have a structure within the context of the overall economic parameters. Okay, does this make sense? But if you're looking at this and you don't know what's episodic volatility relative to what's trending, these are things you got to study. All right, what's the 90-day volatility? Are we in a downtrending volatility like we are now? Yes. Could we see episodic moments where, you know, we rocket to into the early 30s? Yes, but until we've shown that we can, you know, hold above the late 20s for a couple of weeks and it's now a trending situation, well, the price will lead the economic narrative, so to speak. I hope this makes sense. If there are any questions, fire away. There's a lot there. You know, so a trade plan for me would be, number one, measure and map the economic framework. And these things change the econ. These things change sometimes over years, sometimes over months. Okay. Number two, what performs well in those periods? All right. At the moment, tech, consumer discretionaries, industrials, energy do great. Things that don't do great, telecom, utilities, consumer staples. Things that do well, momentum, growth, small caps, high beta stocks. All right. Things that do poorly, the dollar. does poorly in this environment. So you list those. Okay. Then you want to look at your vol of vol. Are we trending or is it episodic where it is? What is the low of that range and what's the high of the range? You know, I can look at our low at the moment and it's, you know, I had VIX at 2074 and this obviously changes. 74 and the top side of that right around 26. So in other words, I'm going to balance my short book much more aggressively when we're here and buy much more aggressively when we're here. Now, obviously, your shorts have to be smaller within the context of this economic here because this is bullish for stocks. So our shorts have to be disproportionately smaller. Where if we go into a deflationary phase, we're going to ramp up our shorts and then we're dealing with volatility between, you know, 27 and 38 or 27 and 42. And above 40, it's just an S show. All right. So while this seems complex, it's really not. We have a very strong structure for what works and what doesn't, and at what levels we're going to put on different trades. Okay. Then the next becomes what's technical for us. Okay. So let's use the dollar, for instance, the euro. Okay. I mean, they might rebalance a little bit, but I don't think much. I think energy is hardly, you know, are we going to see rebalancing from tech and energy? I think that energy is hardly, the XLE is hardly dropped. That's the problem, is I just don't see people getting out of it. Unfortunately, it'd be a nice buying opportunity. All right, so let's look at our euro here. We know that we're in a fundamental phase where the dollar doesn't do particularly well. That doesn't, and here's the confusing thing is that, yes, we've printed $1 bazillion, all right? And you look at the ECB and you're like, hold on, David, the ECB has also printed 700 billion, yes. But this economic phase, it's almost irrelevant because the dollar is just going to do poorly in a high growth, high inflation phase. And on a rate of change basis, you're going to start to see improvement in the numbers this next quarter. And you're going to see continued improvement into Q2. But I bet dollars to donuts come, you know, end of May, June, the market is going to sell off aggressively and the dollar is going to strengthen aggressively. And then the narrative will switch to, hold on, this recovery has left us 15% short, and then the debt burden is going to rise up to meet everybody. Surprise, surprise. But for right now, we're in that, you know, dollar depreciation phase. Okay, so if we look at our monthly here, and yes, I like to do a top-down technical look. So if we look at our monthly, the euro is sort of up against this stuff, isn't it? And this is what makes it tricky, because a monthly chart, it's hard to quantify what this means. In other words, this resistance, yeah, if you look at that, it's the bottom of the candles, you know, on the top of the candles, yeah. That resistance is up there in the mid 125s. So is it incomprehensible that it goes there? No, then it would still be in the resistance zone because it's, you know, this wide, right? And, you know, if you start to take fibs of the overall thing, you know, you're only at a 382 at 25 and change of the whole move. Okay, so my point being is, on a monthly basis, very soft resistance, but likely that in 6 months' time, you're going to see us sort of down here based on that, you know, and then the narrative will switch to, oh my goodness, there's volatility shocks on the market. And, you know, you'll see Bitcoin halve itself from 60 grand to like 20 and just people freak out. Oh my goodness. Meantime, all very predictable stuff. but my point is there has to be a process here. You can't get caught up in the narratives. You know, I don't care who's getting inaugurated. I don't care who's getting impeached. I don't care anything. It doesn't faze me at all. It's what's in front of us right now. All right, so going to a weekly chart, the stochastic's rolled over, but I actually don't consider this a bearish stochastic. To me, the bearish stochastic would be the one that's sitting at the bottom like that. That's quote-unquote oversold. That's the one that's bearish to me. I actually think that this is kind of bullish because this could just very easily flex to the upside and create divergence, and that'll give us a higher high, you know, quite easily. And then you roll over and then, oh, look at the divergence at the resistance, and all of a sudden, in a situation where you're dropping again. You know, I think that that's much more feasible. Now, I'm boiling the technicals down in, you know, speedy fashion here, so stop me if something's untoward for you. And I know some of you you probably don't know how I trade on a technical basis or haven't followed me. So if I lose you, you go ahead. But basically, I'm a price action, support and resistance guy. All right, I use a little bit of oscillator here and there. And the moving averages, while not irrelevant, I don't know, they just are candy. I like to look at pivots for the previous day's range. For those of you that don't use pivots, you know, here I'll drag these across. So this is daily euro and then weekly, daily pound, weekly, etc. Aussie. I've got some S&P stuff here and some yens. So back in the day, probably the mid 125s, Robin. And I'll cut to that here in a minute because what I want to do is give you a very short-term trade plan and then a long-term trade plan and everything in between. You know, the webinar is based around how to build a consistent trade plan. So as I wanted to highlight the economic structure, what works in the context of that, and then how I see things on a fractal basis. Remember, this word fractal is massively, monumentally, you know, Mandelbrot was a freaking genius. All right, and if you haven't read Misbehavior of Markets, I would just can't recommend it enough. It's a little esoteric, and it's definitely not for first date, definitely not for good first date conversations. I would not recommend it. Your compadre will fall asleep. But it does tell you everything about the fractal market. All right, so just reverting back to pivots. Pivots are a great way of giving you a range relative to the previous day's volatility. And this isn't a pivot lesson, but basically back in the day in the pits, traders were in their bunches and they'd shout and scream at each other over prices, and they needed some reference in quick terms as to where they were with respect to the previous day's buying and selling. All right, now, if your pivot ranges are making higher lows and higher highs, that almost by itself is bullish, okay? It's a misbehavior of markets. Pull it up for you. Yeah. It's not an easy read, and a lot of it's esoteric and confusing, but it's, you know, worth this one here. Well worth a look. Okay. Anyway, getting back to our pivot ranges. So these pivots now were used obviously in the 80s. Now, this sort of lineage of thinking has been transferred down to the people trading now. All right, and obviously everything's digital, but the ranges still apply. It's unbelievable, to be honest with you. And so digging in there too is important, and I use that as an augmentation for what I'm doing. All right, so our economic framework says we need to be bearish on the dollar. a technical framework says we've hit some monthly resistance, but it's soft resistance, and 125 looks like that 125 and change looks like where we could be going to. So the big climb to the top of the tree, look over the jungle, says 125.50 is a pretty good spot for where we could potentially be going. Okay, now if we go out to our daily chart again, we just zoom out. We're coming off this 2017 high here. All right, we got some more stuff a little bit lower around, I don't know, 120.20 or so. Okay, now, would we concede that off that 2017 high and the top, we, not in the middle of the range, but we've definitely bounced a considerable distance off the bottom. All right, now, are we anticipating this just continuing to the upside, maybe a little hiccup here in continuation? I don't know. All right, we don't know that. But we do know that this is resistance. All right, why? You know, stuff. All right, and that lasts all the way up here to 2240. So this is, on the buy side, a no-go zone for me. Can't buy there. Because if it's going to roll down, that's where it's going to happen, isn't it? Right here. You know, and actually I'm kind of anticipating this dropping down like that, and I could be wrong, and then continuing back to the upside. Now, let's go to our 4 hour up. So if I take a fib of this drop, it's not rocket surgery to see that between 21.50 and 122, that is resistance for this. So in other words, our bias is on the buy side, but we cannot buy in here, in my mind, because if we're going to roll over, that's where it's going to happen. Okay, now, let's say New York opens, okay, we sort of make one little jog down here and then push up to 2180, which is pretty much what I'm expecting. And then we start to see a bazillion little lower highs and it drops. Is this a valid short? Probably, but it's against our framework. So I'm not digging that trade, even though there's potentially, 150 pips there. The quality isn't there because I'll argue that this daily is still very bullish and the weekly is still bullish. So the top-down fractal look is still bullish plus our economic framework. All right, so on this basis, where do we consider support? Where is the low end of the range? Well, we know the 2017 highs were right here at sort of 2080. And we got weekly S1 at 2020 plus this stuff here. So we got overlapping support right around the early 120 range. Okay, so ideally, this would be where we want to look for euro longs. Okay, alternatively, going to an hourly chart, alternatively, we wake up New York tomorrow and New York opens and price is sitting down here, and we've shown multiple higher lows and an inability to break that. That's not a bad long in the context of everything. Okay, but in my mind, the buy side here is between 120.40 to 120.20, and this gives you 500 pips of upside. And you're going to know very, very quickly if you're wrong in the downside, like within 40 or 50 pips. So this is a scenario where you can probably size up because you got a lot of upside potential and the downside is relatively small in terms of knowing if you're wrong, because if you get through 120.20, now we're talking into the 18s. So you can get out the way quite efficiently then. And yes, there is a lot of pips in between. It's just not in my wheelhouse on a probability basis to trade around in between there. To me, this is the support, and up here is the resistance, and everything in between, the probability drops. Does that make sense? So then it's a case of do you have the discipline to wait for that? Now if price just rises through here and we just power right through here and up we go, well, now you're in a situation where you've broken back above the support. Now you can use that support as a means to buy it. And once again, do you have the patience and discipline to wait for that? I don't know. Survival here is not taking shots in just random areas. Patience and discipline is key to the process. Key. And everybody says it, but can you do it? All right, so number one, economic framework. Number two, what performs within the context of that? Number three, do you know if you're transacting, where are you on the vol of vol range? Are you transacting in the middle? Are you transacting in the top? Are we trending, or is it episodic? This is a webinar I did last, I think 2 months ago. And I'll do it again because I think it's that important. I'll answer that in just a moment, Robin. All right. Then number three is, or number four rather, is use your technicals, or if you're stock trading, if you are looking for the short side and you're at the top of the vol range, you're looking for what's going to not perform, what's being a bad what companies see huge volume spikes and huge volatility spikes on days on short. Those are the ones you want to short at the top of your vol range. What are the ones you want to buy? The ones that sell off under light volume. Okay, that gives you stock picking ideas relative to your framework. Okay, the dollar is a little bit different, but we know that in all but one of these economic frameworks, the dollar performs pretty poorly, particularly these inflationary moments. Okay, and until we start to see cycle highs in this inflationary cycle, the dollar is not going to do well. We need deflation for the dollar to perform. It's just that simple. And I think it's coming, and it's going to be dramatic and exciting. Remember, risk comes slowly and then all at once. So, and then the narrative will follow up, right? The media will catch up to it, which is always a good time. And then I like to do a top-down fractal look. If you're lost in the jungle, climb to the top of the tree. I don't care if you're trading on a 1-minute chart. Climb to the top of the tree and have a look. What is going on a monthly? Where is the resistance? Where is the major turning points? Where can I expect the chop bucket? A big-time turning point is important. My moving average, I like the 200 EMA, the 5 EMA, and the 21, but to be honest, they can come off the chart. They don't phase me. They really are a secondary thing for me, honestly. I can never look at an EMA crossover and be like, oh, look, we've crossed over. To me, it's about the support and resistance on the longer term time frames, and then narrowed down to the shorter that makes infinitely more sense. I'll go through that here in just a moment, sorry. All right. An economic framework. I'm lucky because I have a friend that basically just kicks out a ton of quantitative analytical stuff that I can measure, but a service that I like is Hedgeye, Hedgy, Hedgeye, like hedge fund I. And basically they do all the heavy lifting on the economic side. And I actually do trust their analysis. I don't want to endorse somebody else here. That's poor form, but it is cheap quantitative analysis as far as economic frameworks. But otherwise, you can do it yourself. You can go and measure things like CPI. You can go and measure things like PPI. You can go and measure things like GDP, which is a lagging indicator. You can go and look at consumer reports, except there's a lot of information that you can tabulate, but truly earnings growth and inflation are the two things you really want to track. And I argue that you can do those things yourself and then measure those on a rate of change basis. But how about I'll do this next webinar, keep an eye out for it. It's a question that needs the whole 45 minutes to answer, Robin, honestly. How do you develop an economic framework? That is something we could dig into for 2 hours. Because it's, I don't want to give you the 2-minute answer on that. And you can also email me, c5davidpegler@yahoo. I'll put in here. And I will give you the resources that I use. And obviously, I don't use one single one. I would caution this, and this is sort of, it's a contrary thing to say since we're doing a webinar here at FX3, but your own analysis is very important to your trading success, in my mind. Too many dissenting voices can be very tough. Would you agree with that? How you see the market's important. And I don't think that, there's a lot of people that know a lot of things and are very good. But if I say to you, well, I'm going to buy this euro, I'm going to all in on the euro long at 120.20. Okay. Now, I don't like going in, 6% of my portfolio on the buy side. I might go, 25 basis points here, bips. And then at 30, another 25. And then at 2020, 200 basis points of my portfolio. So in other words, I might build a position all the way down into the late 19s and I still don't think I'm wrong. And I'm very happy sitting myself in 2 days and 3 days in a trade where you might not be. And I don't care. I'm okay with it on a time fractal basis as to how long that takes. I'm also happy to sit and wait for it. And if it goes to 125 and I don't catch a single pip, I'm fine with that too. I'll look at other things. I'll buy the freaking Cosby, the doctor. It doesn't faze me. But somebody else, they might be like, oh, he's bullish on the dollar. Oh, he's bullish, or he's bearish on the dollar, therefore I get long the euro. That is a one-way ticket to poverty street. And what I can tolerate risk-wise is different to what somebody else was. And what I can tolerate time-wise is very different. I'm happy to sit in stuff for weeks, months, where somebody else might sit in it for 5 minutes, bite their nails, jump out, and call it a loss. So when you're taking on opinions, when you're developing your own opinion, that's so important. And this isn't a lecture in, I'm not trying to give you a lecture in feeling good about life, but when you, that is just so important, is take into time horizon account big time, because that is directly proportional to risk tolerance and what you can deal with over time. All right, should we do one more? We got 4 minutes here. So this to me is dead zone. This to me is buy zone. If it breaks above here, you know, pick up the long again. And if you get back below 121.80, dump it, you know, fair enough. So that's our little Euro plan. Now, I've been piling into Ethereum lately. I think that's got buku upside. But let's talk about this pound. The other obviously important thing for a trade plan is to execute on the process irrespective of what your brain and heart and all the other fields are trying to tell you. How many, and we've all done it, you develop a trade plan, price gets to your level. Remember, if on the buy side, for price to get to the low end of the range, it has to be red and scary and weird. And how many times has it got to your level and you're just like, oh no, not feeling that. And then you don't trade and you look back in 48 hours and it did exactly what you expect, but you were terrified. The only way to get around that is to trade so small that it's almost inconsequential. I'm talking Big Mac small. Like you trade it and it's going to cost you the price of a Big Mac and a Coke, $8, $7. And you do that 100 times, it will develop a habit of confidence. You know, how many of you have done this? And I don't want to neglect this, but I feel like the psychology is important. You have a $2,000 account. Okay. And before you make a trade, a mini lot, you build this whole framework and you spend hours developing this framework. And you spend hours waiting on your setup. And you execute the trade and it makes you $10. Talking hours now. Okay? Hours. And then you put on another trade and you spend 12 hours setting it up and you execute and you make $30. Okay? And you do this over and over again and you build your account up to $2,100. And it's taking you 40 hours to do it. Well, that's $2.50 an hour. Okay? You look at this, you're like, well, I'm up 5%, mind you. And prospectively, it's taking you, depending on your trading load, a week to a couple of weeks. All right, and you look at that, and you're like, $2.50 an hour? I could, what? But you're up 5%. And then you throw a little bit of caution to the wind, and you up your trade size, and now your account, you take that one loss, and now you're at $18.50. And now you're just like, whatever. And before you know it, you're at 14 and change, and you have to like make 100% to get your money back. It's very easy to do. Well, this was the process that was making you money, and it's a grind and hard. Okay, but then you slip right back into this habit, and all of a sudden you've killed yourself. This is the process you need to focus on 1,000,000 trillion bazillion %. It's too easy to go here, isn't it? And that comes from ill discipline. That comes from sometimes you're just wrong, and that's okay. This predominantly will be trade sizing. It's okay to size up on the good stuff, but it's not okay to chase things in the middle of the range like the euro is now. If it goes to 125, who cares? Who cares? Okay, like 120.80 I've had on the buy side for 4 days last week. Anyway, little pep talk, unnecessary, but little pep talk. We're going to run out of time, but you know, pound is more upside here too. Same sort of thing. Middle of the range. Let it drop to the support, you know, 134. Trade that thing up 400 pips. All right. Well, I hope you got something out of this. And we'll talk economic framework next time. All right. And we'll dig in hardcore. And we'll do a little demonstration of what's worked historically relative to other things. Okay. Email me, or you can find me on the twit at ForexDavid, ForexDavid. And FX Street, I'll send you a new headshot. I think that one's like 12 years old. I'm much more cynical now and have no hair. And Happy New Year. We'll see everybody soon. Thanks.